Okay, folks, today we're talking about the settlement closing cost statement that you do with a real estate transaction or for a mortgage loan. Folks, the most confusing document in the United States to figure out is a settlement statement on a purchase or refinance transaction. So we're going to break down the closing costs here for you. There's basically three types of closing costs. There's loan costs, there are prepaid expenses, and then there are escrow costs and governmental costs. Those are the three broken down. Loan costs have to do with whether you're paying origination fees. In most transactions, you will not pay origination fees, or you shouldn't be paying origination fees to buy down your rate. So you will not be paying points or a percentage of the loan amount in most transactions. The other fee that you pay in a lending fee is underwriting. If you're working with a broker, you may pay a processing fee. Underwriting fees run between $9.50 and $11.95, and a processing fee runs you between $6.95 and $9.95. If you're working with a broker like me, you will not be paying a processing fee with us. So you'll only be paying an underwriting fee, and then you'll pay appraisal fee, which will range anywhere between $5.50 and $8.50. Depending on what lender has to be used. So I wouldn't haggle too much over the appraisal fee if we have to pick a lender that charges a higher appraisal but gives you a much better deal. So that's what determines what lender we're going to use in your transaction. The other lending fees are minuscule. You're going to pay a flood check. I'm not going to go into details what that is, but every lender charges a flood cert check, which is somewhere in the neighborhood of $50. You're going to get what's called a tax service, which checks to make sure you pay your property taxes every year. That runs about $75. And then you have what's called prepaid expenses. Prepaid expenses are considered closing costs. I don't consider them closing costs, but they're what's called recurring costs. They're recurring because you pay them every year. Your prepaid expenses includes your property taxes, your fire insurance, your interest that you're paying per day, and your mortgage insurance premium if you're putting less than 20% down. All of those are considered prepaid expenses that you have that are included in the loan transaction. If you impound your taxes and insurance, you're going to pay a lot more in prepaid expenses. You have to impound your taxes and insurance if you're putting 5% down or less in most cases. So on a $300,000 purchase, let's bring it up to date. On a $500,000 purchase, that could be as much as $3,500 in advance that you have to set up your impound account in order for your taxes to be paid on time. You don't have to do that. You can pay your taxes on your own, and then you don't have to set up an impound account. And then the rest of the fees include title and escrow. Usually title and escrow fees are split by the buyer and the seller. The owner's policy, which is also a title insurance policy, protects the title of the property that you're buying, so there's no erroneous people that can get onto your title. It insures the title against all old deeds and any kinds of encroaches on the property. That's what a title insurance policy does. The lender's policy, by the way, the owner's policy is not optional, as it says on the good faith estimate. It's not an optional policy. No lender will close without it, even though it says optional when you get your estimate. And the lender's policy insures the lender. Can't avoid that either. Now, in California, sometimes, depending on what area you live in, you can negotiate and have the seller pay the full title policy, or what's called the owner's policy. And that means that policy will be, usually, it could be as much as $1,500 split evenly between the two of you. But if you have the seller pick it up and ask your agent to have the seller pay for it, that could save you as much as $750. So you should think about that. And then the part of the title escrow fees usually includes recording the deed, which is between $100 and $160. And then you're going to have about $340 other what's called doc prep with the escrow company. Some people don't charge it, but they collect it in the owner's policy. So that's why it's good to get the seller to pay the whole thing. So the doc prep, if it's added onto the owner's policy, will be picked up by the seller. So you lose the doc prep of $340 and half of the title insurance policy, or what's called the owner's policy. You're going to pay recording fees, as I said, and any other fees associated with the transaction. You're going to have a notary fee, somewhere between $175 and $200. Now, if you sign the docs at the escrow company and don't use a notary at home or a mobile notary, that'll save you between $175 and $200. Hopefully that has helped you. I'll make sure that you punch the subscribe button below here so we can get an idea what kind of videos you like and fine-tune our videos in the future. Thanks for listening.